Now, you are in the camp that actually sees an easing cycle from the Fed from here. What do you see and why? What is it in the US economy that tells you we're going to see more cuts from the Fed?
So we're currently in a phase which started from summer, where there is some relief from the trade wars, some relief from the exit of the no-deal Brexit. But let's be in spring. And there is no more fiscal expansion. In the last 2 years, we had a huge fiscal impetus from the US government, and this year in 2020, there will be none. So that's a headwind to growth. And we expect the confidence, which has been rather slowing down, the employment market to slow down. And these are gathering on top of the corporate margins in the US, which have been falling in the last quarters at the macro level, not only the quality companies, but in a larger way. And that has always been a lead indicator of a slowing down of the economy.
Alain, good morning to you. One of the things that caught my eye is the reference to the yield curve by Mr. KAPLAN and the movement in the yield curve. We've gone from negative on 2s10s back up to just sub 30. Given the context of how you see 2020, will the yield curve steepen further or have we topped out?
We can expect some steepening of the curve. But later, let's say from Q2, Q3, when the Fed restart going down on the interest rate, we expect 4 times 25 bips of cut next year. The short-term rates will go down faster than at the long end of the curve. We expect bond yields to rise in price, so yields to fall. But we expect the long end of the curve to fall at a slower pace than the short end of the curve. So yes, steepening, but for the slowing down reason of the economy.
Yeah, so that makes sense as to why you see a 1.2% handle on the 10-year Treasury yield by the end of 2020. It's one of the most bullish calls out there, actually, on Treasuries. So you're long US Treasuries. In terms of how else you hedge against a cyclical slowdown and a recession, what are the key calls that you would be making other than being long US Treasuries?
So within the equity market, small caps are definitely the short leg. As small cap have one characteristic is to be super indebted. The equity to asset is very low when you enter the smaller the size of the market cap within US equity markets. And that means when you're highly indebted and you face this slowdown, debt will become a problem. This is also one of the reasons why we have downgraded the US credit asset class against the sovereign bond on treasuries. Also, gold within the commodity market will appear as a safe haven later. We have trimmed for now the gold exposure with the relief coming from the big risk we had. But later on in 2020, it will be a wonderful asset to hedge.
Tell me this, Alain. We have this debate that Nair and I started the show with between Jeffrey Gundlach saying that the copper to gold ratio is a very bullish thing to look at in terms of global growth for next year. That'll take yields to 2.125% versus the Citigroup note, which says, and they have a base case, which is that recession would need to happen to get rates down to 125. Do you, well, I suppose, which side of that trade do you concur with? I know that you've got a low call on your yields down at 120, so I presume you disagree with Gundlach.
So to make a long story short, the gold to copper ratio is a quasi-perfect proxy to gear to long-term rates in the US. So when long-term yields go down, gold outperforms copper and vice versa. So the debate we had earlier on where are we heading for the end of the year 2020 on treasuries, if you are bullish on rates, if you expect rates to go down, then you should be bullish on gold against copper and vice versa.
Yeah, so you agree with Jeffrey in that it's the perfect sort of correlation between copper, gold and treasuries. You just take the opposite view to him, so that's interesting. What does that mean in terms of the dollar and your dollar outlook and how you would allocate across currencies, given that you do see this mild US recession in 2020, but then an upturn in 2021?
Yeah, so in 2019, from mid-January, we had the Fed changing outlook from tightening to flat and then loosening. But the other central banks catched up. You had the Bank of Japan, you had the European Central Bank moving down and loosening the monetary policy in parallel of the Federal Reserve. And that is why the currency market and the dollar remain in a very low volatility environment, and the US dollar has continued gradually to rise, but in a very slow speed. In 2020, we expect the Federal Reserve to act decisively on rates, but we do not believe the other central banks are going to catch up. And that means somewhere in 2020, there should be a trend reversal. And if we love the value style, so to embed in a portfolio some assets which are cheap, the US dollar is the antithesis of being cheap. It is the most expensive G10 currency. So we expect a trend reversal on the USD next year.